Mark, good to see you. Today, we are talking through the concentration risk lurking in your portfolio. A lot of investors have large positions in S&P 500 index funds or in mutual funds that use the S&P as a benchmark. And stocks are up quite a bit this year, which is, of course, great news for your portfolio. But I think a lot of investors don't realize that 80% of the market moves that we've seen this year are due to only 10 stocks. What's going on here?
Well, yeah, it's interesting because a lot of us believe that if we own the market, which is the S&P 500, we have a well-diversified portfolio.
Hmm.
We have to realize the way the S&P is structured, it is based on what we call market capitalization. So the bigger the company the stock is, the value of that company, the more it's going to drive those returns. So you can see that 82% of the returns are being driven by 10 stocks just because they are so much larger than all the rest that are included in the S&P. So what
Right.
you end up getting is what we call heavy concentration risk, and you can see a lot of that is predominantly technology.
Right. So let's see what that looks like just in another visual. This is the S&P 500 year to date. And as you mentioned with that market cap, you can see those tech stocks in the upper left-hand corner, right? We haven't seen this kind of concentration in 50 years since 1973, Mark. So what risk does this present?
Well, it's interesting you bring that up because you remember 1973, 74, we had a bear market. And when you think about it, going forward, there's some inherent risks, or there's more risks now, I believe, than what we probably have seen in the last 5 years.
Hmm.
Now, everything looks great today, and I'm not saying that couldn't be the same 6 months from now, but the other point of it is that has the Fed ever really been able to engineer a soft landing? In addition to that, yeah, you've got a few number of companies driving all of the returns. I mean, you've got Microsoft up 54%, Nvidia 218. I mean, it goes on and on. And then you look at the rest of these companies, whether it's energy, real estate, consumer defensive, healthcare, a lot of these stocks are down for the year.
Right.
So you could conclude that, hey, this market is extremely overvalued. And then in conjunction with that, with all the geopolitical risk that's outstanding, I think people really need to take stock in what they're doing and really look at how much concentration risk they have in their portfolios.
Right, of course. And you do have some tips to help people reduce any potential volatility. And the first one seems straightforward, reduce concentration.
Well, yeah, reduce concentration. Obviously, one of the things that we always say, control the variables that you can control. You can control your asset allocation. So if you have a heavy concentration in the S&P 500, yeah, you've got to look outside of that and see what other options that you have. Maybe you need to bring in some other, more value type companies that aren't so technology driven. Now, we're not recommending getting out of growth specifically or technology, but yeah, we want to be able to reduce that in the event some bad stuff happens over the next 6 to 12 months.
Hmm. And specifically, you say perhaps consider hedged equities or buffered ETFs.
Yeah, so one of the great things about this environment today and with technology, we have these types of tools that we can use. So hedged equities, defined outcome ETFs or buffered ETFs, they're really giving us a hedge against market downside. So ultimately, as a portion of somebody's portfolio, these can be positioned as playing defense. Again, it's like a football team. I mean, if you have a bad defense, you're not going to get to the Super Bowl. But this is the balance that we need. We need a good offense and we need a good defense. And hedged equities and buffered ETFs can provide that.
Another option would be structured notes.
Yeah, so structured notes, they've been around since the early 70s. They're issued by banks and they pay really good rates of return or interest rates. There's growth notes, there's income notes. But if they're structured correctly, again, these are an alternative to the market that gives us a steady, reliable cash flow back into the portfolio. And it's further de-risking our portfolio away from that concentration risk.
Hmm. Another option would be guaranteed insurance products.
Yeah, so here's an arena that some people really like, some people really don't. But I think if you have to investigate this. But there's been a lot of academic research that's been done that says, hey, by using a guaranteed insurance or a private pension account, essentially a deferred annuity of a fixed or a fixed index annuity, what's happening is we're de-risking the portfolio. We're getting rid of interest rate risk, and we're still able to obtain a decent growth rate. A lot of times these become bond alternatives because the bonds have interest rate risk, and a lot of people don't understand the bond market.
Hmm.
A number of things that we can use. Maybe it's a combination of all four of those, maybe
Hmm.
it's one or two of those, but I think people really need to look at their portfolios at this point and really understand how much risk they have in that portfolio and what are their opportunities to de-risk the portfolio.
Right, right. So interesting to kind of get this peek under the hood with how things work, Mark. If somebody wants to talk with you and find out whether they are properly diversified, what's the best way to reach you?
Well, yeah, they can simply pick up the phone, call us. The phone number is 303-681-0113. We'd be more than glad to talk to anyone. They can schedule an appointment, or you can go to our website, mcgregorwealth.com. We have a link in there where you can also schedule an appointment.
All right. Mark, thank you.
All right. Thank you, Aaron. Have a wonderful week.
You too.